Hello.
I don't know what happened there. Let's see.
I didn't know
Okay.
if we were still recording, but we're just sitting there, so I don't know what happened. I said, let's leave and come back.
Yep, yep. We were you were still on. So on my side, you were frozen and Fatma was frozen, and it looked fine for me. And then I checked on YouTube, and you were on YouTube, and I was not. So and then I had to force close Zoom
Everything. Yeah.
and come back on. So I had no idea. No idea what happened there. But is this working again? Are we still streaming?
I think we
Yes,
Okay.
are.
boss.
All right. So all right, we're live.
We're back again, guys.
We're back again. All right. Where did I cut off?
Um, I'm thinking it was
And
the
you
intro. I
owed,
was,
yeah,
yeah,
Oh,
it's still the intro.
how I
Yeah.
owed
yes,
$1 billion. All right.
yeah.
I talked for a while after that. Okay. So I owed a whole bunch of money. We're getting the short version now. I owed a whole bunch of money. I had to fix my own problems. That's how I got into the tax world. And have since then have made it my mission to save people from not only from the troubles that I went through, but to save them just on a macro level. Because I don't know about you guys. It doesn't even matter what you think about the election and which side you're on and what your policies are. No matter what you think about what politics should do, I guarantee you are not happy with the way government is spending money. So the way to fix that fundamentally is to not give them any money. It's really that simple. So how do we do that? Well, we apply the rules that exist, and you can always lobby for new rules, and we'll talk about that with Trump. Um, you apply the rules that exist and structure your tax world in a way that is most tax advantaged that you can. And there's lots that go into that. So part of the problem with tax work in general is that everything is custom because it depends on your facts and circumstances. In fact, I'm going to skip to this right here. The answer to every tax question is
It
it
depends.
depends. And because it depends on your situation. So, I was just talking to a client earlier, and she is an entertainer. So, she goes around, there's band, does performances, et cetera, et cetera. And, so what is a, under Section 162, the question is, what is necessary and ordinary expenses for that kind of business? It's like, well, a makeup artist, for example, might be an expense for her as an entertainer. You as whatever else you do, probably not a deductible expense. So, everything depends. It depends on what's going on in your life, in your world. Now, there are generalities that we can approach. So one of the things, I don't know if it got cut off or not. I was talking about the workshop that we're going to be having coming up. Um, and it's going to be on S corporations. So the vast majority of the time, if you have any business activity, you're going to want it to be inside of an S corporation. And there's various reasons for that. But the most basic reason is that the net profit from an S corporation does not carry self-employment tax consequences, meaning that you don't have to pay Social Security and Medicare on it. And that's a 15% advantage to S corporations. And that's the biggest chunk of why S corporations outperform other types of entities, like Schedule Cs and 1065s and those kinds of things. Um, and I'm developing a software tool that you can put in your numbers and you can put in your filing methodology, and then you can compare and contrast like how those same numbers would look in an S corporation. Still under development, but once I get that working finally and I'm happy with it, we're going to be holding a workshop. It'll probably be in a few weeks. Um, and we'll talk about all the whys and wherefores and all the depends things that come along with S corporations, and then whether you might want to do that or might not, because everything depends, right? All right. With all that said, last week, a week ago today, there was an election. I don't know if you guys heard about this, but you know, Trump won the presidency. The Republicans are controlling the Senate with at least 52. They might get another one, but at least 52 senators. And they have a very bare majority in the House of 219 representatives right now. So it's looking like, and of course, results still to be certified and yada, 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 but it's looking like the Republicans are going to control the House, the Senate, and the presidency. So, what does that mean for you and me? Well, it means that there is a much higher likelihood that tax reform legislation can actually get passed. So, you know, all tax bills have to pass through Congress and then they get signed by the executive, same as any other bill. Um, when it comes to tax policy specifically, it's very hard or very unusual, let's say, for the parties to work together in a bipartisan manner and produce a tax savings kind of result. So, um, so the fact that the Republicans got all three suggests that they will be able to get some legislation through over the objections of the Democrats. And so all these things that Trump has promised on the campaign trail are not that they're going to happen, but they're more likely. So I wanted to take a little bit of time before we get into the Q&A, and obviously we're getting cut short because of all these technical problems, but I want to take a little bit of time to talk about Trump's tax proposals. And we did a deep dive on this last week on the Navigators call. So if you guys aren't at the Navigators, you should be, because we have weekly Zoom calls where we all just get online. They're not public, they're just for our insider group. But it's a great time. So some of the things that Trump talked about on the campaign trail. One is making the Tax Cut and Jobs Act permanent. So the Tax Cut and Jobs Act was Trump's original tax reform back in 2017, and that's what changed a whole lot of things when it comes to the tax world. So if you're old enough, you remember we used to have exemptions that was based on your family size. The standard deduction was a lot smaller. Um, and so, you know, all of that went away and new systems were put in place. Now, those new systems were put into place in a 10-year time horizon. And there's technical government reasons why it was done this way, because they could do this and avoid a filibuster from the Democrats if they did it in this, what they call revenue neutral manner. And so they created tax breaks primarily for corporations and businesses, small businesses too. And the people who so-called paid for it are people who live in high tax states and itemized their deductions. That's kind of how it worked. So there used to be a whole lot of deductions on the personal side that just vanished. Um, and so like moving expenses was one of them. If you moved more than 50 miles and you did it for work purposes, your moving expenses were deductible on your federal tax return. That went away. Um, and some states still allow for it, but federally it's gone. Your state and local taxes. So your state income taxes, your real estate taxes, those used to be unlimited. So if you're a high income earner in, one of these high tax states like, New York and Hawaii and California, New Jersey, um, that used to be a major deduction for you on your federal taxes. That got limited to $10,000. And the reason these limitations were introduced was to pay for and make revenue neutral the projections of this tax change back in 2017. So a big question becomes, are they going to have to go through the same process again? Because as we approach 2026, we're in the tail end of the Tax Cut and Jobs Act years, and we're seeing things change. And so what they want to do, what Trump has said he wants to do, is to make the original implementation of the Tax Cut and Jobs Act permanent. And the big thing for that is that they want to repeal the cap on state and local taxes. So all those, New York high paid people that were paying, tens of thousands of dollars in New York income taxes, you're going to get those deductions back if Trump gets his way. Now, will it actually happen? Don't know. But at least they're talking about it. Another thing is 100% bonus depreciation. This was a huge gift from the Tax Cut and Jobs Act. And there have been implementations of this over time. Like back in 2011, we had 100% bonus. But Tax Cut and Jobs Act expanded that over many years. And so if a company or business buys an asset with very few exceptions, you are able to write off the entire purchase of that asset in year one, as opposed to spreading it out over multiple years of its lifetime. That was huge, especially if you are in any kind of capital intensive business like real estate, for example. It was the classic case. But if you buy equipment, you buy cars, you buy, cars are kind of a special thing, but computers and all sorts of stuff. We were able to write off the entire thing in year one, and that was fantastic. as we come into the end of the Tax Cut and Jobs Act from 2017, that 100% is being reduced to 80 and then 60 and then so on. So getting that permanent would be great. Fixing the R&D credit for software would be great. I'm not going to get into all the specifics, but it was totally screwed up starting in 2022. And software companies have been paying through the nose on their taxes on money they already spent because of that, and they want to fix that. So those are some of the things. So that all comes under the umbrella of fixing and re-implementing the Tax Cut and Jobs Act. So that's one element. And then there's new stuff that he's talked about. The no tax on tips. So, we had a little bit of a discussion about this on the Navigators call, where we were talking about how, most people these days, when they go out to eat, they're paying with credit cards, and the tips are on the credit card, so they get reported. It's like, okay, that's true as far as it goes. However, uh, a lot of stuff goes on in the back of a restaurant or a bar or what have you. There are other people like barbacks and the cooks and things like that get tipped out from the wait staff, and that's generally in cash. So, how much are they reporting? They're supposed to report everything, but whether they do or not is debatable. But if tips were to be non-taxed, that would be a huge win for people especially in higher end restaurants and things like that, because the fancier the place, the more percentage people make in tips, and it can be huge numbers. I've seen crazy numbers over the years, and as it is now, it's just part of your ordinary income, and you have to pick that up, and that creates the incentive to underreport to the extent that you can. If tips go untaxed, then there's no incentive to not report. You show everything, and then you can do stuff like buy houses because you have income that you can show on tax returns. So there's some knock-on effects like that are kind of interesting. Another big one is they want to get rid of tax on Social Security benefits. So Social Security is weird in that the amount of tax you pay on the money you receive from Social Security depends on how much income you have overall. So if you're a high income person and you're getting Social Security benefits, that Social Security benefit can be taxed on up to 85% of it. So if you're bringing 50 grand worth of Social Security benefits throughout the year, then you might get taxed on, I don't know, whatever 85% is, 40, let's 42,500, I guess, is 85%. So, and that just gets included as part of your income. So what Trump has proposed is anybody who's receiving benefits, they don't pay tax on the benefit itself. And critics have pointed out that, well, if you reduce the people paying in to Social Security, then you are going to be shortchanging Social Security even more. And I actually went through all the math on this, and that's true. It'll shorten the life of Social Security because there's a drop dead date that they publish every year. Right now it's about 2032, and it'll shorten that closer in time by about 6 months. So it's not honestly that big a difference, but it is 6 months of difference. So that would be huge for retirees. People on Social Security disability typically don't have other sources of income, so it's not such an effect for there. But retirees might have Social Security plus a pension plus some stock dividends. Depends on how they end up retiring. But that could be a significant impact for them, and that would be interesting. And yet another one that he's talked about is eliminating taxes on overtime pay. This would be really hard to implement, but I guess it could be done at the payroll level. And obviously that would incentivize people to work a whole lot more overtime. But people are already pretty incentivized because most places that pay hourly and you're eligible for overtime, you're getting time and a half or double time or what have you, for holidays and whatnot. So, that's all pretty interesting stuff. Again, remains to be seen how much will be implemented. The big thing that people talk about is tariffs. And Trump has floated this idea that we're going to impose tariffs and get rid of the income tax altogether. Now, if this happens, don't worry about us. We'll be fine. Uh, we'll find other things to do. But fundamentally, this is not going to work. So, I did a little ChatGPT research, and basically, last year, the government raised about $4 trillion worth of income tax, the federal government. And of course, they spent more, so there was a deficit, but 4 trillion is the money that came in. And, I was like, well, how much in goods are imported into the US that you could impose a tariff on? And it's actually around $4 trillion. So if you wanted to impose a tariff on $4 trillion in order to raise $4 trillion, you would need at least 100% tariff on everything. And then, as those things became twice as expensive, something goes up in price, people buy less of it. That's just how things go, right? So by the time the system got implemented, you would actually need, 150 or 200% tariff across the board in order to actually raise the federal tax revenue in order to make that all balance out. So that's not going to happen. Specific tariffs, sure. He talks about 30% tariff on China and 100% tariff on cars. Yeah, all those specific things can be accomplished, but a whole sweeping change where it replaces the income tax entirely is not realistic. And what you got to be real careful of is that if you want to have any kind of system, and there's various proposals out there, if you want to have any kind of system that gets or replaces the income tax, it is critical that there's a constitutional amendment passed in order to repeal the income tax. So back when the country was founded, there was no income tax. All taxes were raised by tariffs and fees and things like that. And then there was a short-lived income tax during the Civil War, which was found to be unconstitutional, correctly so. And then in 1913, the income tax amendment was passed. And from there, like always, it was always, oh, only the rich are going to pay it. You, normal person, you don't have to worry about it. And now here we are 111 years later, and we all have to worry about it. So what happens is that if some kind of new system were put into place and they said, oh, it's going to replace the income tax, but the power to assess an income tax were still there in the Constitution, then whether it's this administration or some administration in the future, they're going to end up using that power. So whatever system is implemented, you gotta make sure that they can't do both, because then you end up with high tariffs, you're paying through the nose for imported goods, and you have an income tax, and then you just get smashed in the middle of that. So for anybody who's hoping for a tariff system, that's fine, you can do that. It's not going to work, but even if it were, you got to make sure that you repeal the income tax or at the same time that you do that. So that's my that's my high horse on the tariff idea. But and one other thing, he wants to reduce the corporate income tax rate from 21% to 15%, which is nice, but it's not a deal breaker. It does change the math on a couple things, but the corporate income tax is a bit of a red herring in that it doesn't actually raise that much money. Most of the revenue is from individual income taxes. That's where the lion's share of that $4 trillion comes from. So the things that affect that are going to be the big movers. All right. So that's my spiel on the election and what we're looking forward to in 2025. Obviously, we will keep you up to date with the legislation that that evolves over time, and if there's big changes, we'll let you know, and we will do our best to help you save your part of the $1 trillion that we're going to save Americans. All right, now we only have 50 minutes left, but I know Serena's got questions. So let's dive in and see how many we can get through it in a lightning round and see if I can talk less.
So we have a client that asks, he said, Neil, I got a friend who's a freelancer and isn't sure what she can deduct. What should she know about claiming business expenses?
Okay, so I wrote 3 different ebooks on freelancers specifically, which I don't think I ever published on Amazon, but I have them in my files. So fundamentally, the criteria is the basic criteria is necessary and ordinary. So basically, whatever is necessary in order to run your business and ordinary. So like if you're a freelancer, is it ordinary to buy a Lamborghini? Probably not, you know. But it might be depending on what it is that you do for freelance, so you could be a freelance luxury car driver and shuttle people around in your Lamborghini. Then okay, then we can start talking about riding off a Lamborghini. But yeah, so that's the basic criteria. Anything and everything that is related to the functioning of your business that is justifiable, basically. Now, there are additional tax strategies that we can layer on top of that, and that's going to get into, what's your tax status? Are you Schedule C? Are you an S corp? Are you partnership? Are you C corp? Um, are you paying for things that are business use out of your personal funds, and then you can take reimbursements? Are you holding management meetings and deducting those expenses correctly? All those kinds of things are things we can start to talk about once we get into the details. But the basic rule is necessary and ordinary expenses. So, if you find yourself spending money and you say, am I doing this for a business purpose in order to generate more revenue at some point? Then yeah, that's a deduction.
That's fast. Okay, awesome.
I'm trying to speed through it. So I'm not going to get into
Perfect.
all the it depends, but just a couple.
Right. Understood. So we have another client that asks, can self-employed individuals deduct health insurance premiums? And if so, how is this deduction applied?
Yes. So if you're self-employed, then there's a special line on Schedule 1 for self-employed health insurance premiums. And that is just a Schedule 1 deduction, meaning that if you have a day job and you receive a W-2, then your health insurance premiums go into Schedule A. And those only begin to count if or once they exceed 7.5% of your adjusted gross income. And then that gets included with your mortgage interest and your state and local taxes limited to $10,000 and your contributions and all that kind of stuff. Under a day job scenario, very, very difficult to deduct, even if you're paying out of pocket, very difficult to deduct insurance premiums. But for self-employed, different rules, goes in a different place. This is one of those, it depends, right? And it becomes just a straight deduction. Now, one thing to keep in mind is that if you're self-employed and you're paying self-employment tax on that amount, the self-employed health insurance deduction only affects your income tax. It does not affect your self-employment tax. So some people might get confused. It's like, well, let's say I have a $30,000 profit and I have $20,000 worth of insurance premiums, because that can certainly happen. And so I should only be paying tax on 10 grand. And the answer is that yes, for income tax purposes, that's true. For self-employment tax purposes, you're paying on the full 30. So, it's people can get caught up in the nuances there. But yeah, it's on Schedule 1. Schedule 1 deductions, page 2.
So Schedule 1 is the answer, guys.
Yep.
So another question, Neil, is, are individuals required to report income from side hustles or small online businesses? And what is the threshold, if so?
The threshold is 0, but yes. So under the way U.S. tax law works, all Americans, all U.S. taxpayers have to report all income from all sources. There is no exception to that. Except that's not true. There is an exception to that. So certain things are excludable under certain circumstances, but generally no. So if you have a side hustle, you make $1, then you're supposed to put that on your tax return somewhere. Now, where it goes depends on what it is you're doing. And if there's expenses associated with that, then okay, you have the $1, but then you have expenses. Maybe you end up with less. Maybe you end up with a negative. Just kind of depends on the situation. But yeah, you are required to report side hustle income of all sorts.
Right. So that's not a it depends question.
I mean, there is an it depends, and it's killing me to not go into it, but for sake of time, I'm gonna skip that because it's a very edge case scenario and doesn't apply to 99.9%.
Right. Understood. So we have another question, Neil, about a married couple.
Yep.
What factors determine whether a married couple should file jointly or separate?
That's a question we get a lot, actually. And,
Mhm.
it's interesting. So for a given amount of income, so let's just pick a number, 100 grand. If there's $100,000 of income in a married couple, then it's always going to be a lower tax scenario in order, to file that as married filing joint. So combining that household into a single thing and applying tax rates at $100,000, as opposed to 50-50 or 25-75 or whatever the split would end up being. filing separately. That's kind of the general rule. However, there can be cases where things get twisted around, right? So the case we see a lot is actually student loans. So some people are on student loan repayment plans that are income based. And if they file jointly, then the student loan people will see the joint income and actually raise the monthly payment on their student loans. And people want to avoid that, so they'll pay the higher tax in order to save on the student loan payments. So that's something that we've seen many times over the years. Another case can be with children, and sometimes it's better for one spouse to claim the kids just because of the income and the credits associated with the kids. There's certain rules regarding residency and like where people live to make that work. There could also be cases where somebody might not want to file jointly. So we had one client actually who is in this weird kind of business. He's like a minority owner of this odd business and just got married. And his new wife said, I'm not filing jointly with you until you get all this stuff cleaned up. And that's just okay. It's not a tax argument, but it's just like I'm not going to get involved with your mess. So that's another case. And then there can be other scenarios where it's like, let's say it's a second marriage or something like that, and somebody owes back child support, and the IRS is going to take any refunds to apply to back child support, and the other spouse, the new spouse, doesn't want to get involved with that, and that could be a reason to file separate. So in those scenarios, there are ways to kind of allocate the refund so that this part is not related to this person who owes this money, but it can be difficult to get that actually done in a way that achieves the outcome that people want. So sometimes people will just file separately just because of that. So the general rule is whatever your combined income is, married filing joint is going to be the lowest tax assessment. But there are all these complicating factors that can sometimes make it worth doing separately. And you got to evaluate that on a case-by-case basis.
All right. Do we have time for one more or no?
Let's try one more.
Okay. So under what circumstances are unemployment benefits considered taxable income?
Any circumstance except for 2021. Yeah. So normally, unemployment is taxable. And during COVID, there was an exemption that was passed for, if I'm remembering right, the first $10,000 or so worth of unemployment benefits they excluded from tax. And they did it like after the year was done and after we'd filed tax returns, which was crazy. And then they retroactively applied it to the people who had already filed. COVID was a crazy time. So, but in general, it's just income, and it gets included as part of your ordinary income. It's another Schedule 1 item. It's a Schedule 1 addition rather than a Schedule 1 subtraction. And yeah, it's just part of it. Some states will exempt some unemployment income, but I can't remember which ones off the top of my head, but I have seen that. And yeah, that's the general rule. So barring special legislation from Congress, it's part of your taxable income. All right. Well, that was a quick one. Let's do one more.
One more. Okay. Let's see. Okay. So what qualifies someone for earned income tax credits, and how are they eligible for that credit?
Yeah. So earned income credits come primarily from children and having earned income, hence the name, in a certain range. So as a single person, you can get earned income credits if you make less than $13,000 or $14,000 a year. And earned income is defined as, money you're paying either self-employment tax or payroll taxes on. So if you get gambling winnings of $5,000, that's not earned income because there's no payroll tax associated with it. If you have a part-time job and you make $5,000, then yes, that is earned income. So for single people, it's a minor factor. We don't see it too often. For people with children, though, the numbers go up significantly, and I'd have to look at the latest tables. But basically, if you have up to 3 kids, you can make 40 to 50 grand and get earned income credits. So every springtime, when people start filing taxes, you'll start to see these signs on the side of the road pop up. It says $7,000 for tax credits, available. And that's what they're talking about, because the earned income credits can be significant if you hit the right range of income for your family size. And it goes, it's either one, two, or three children. And obviously the more children, the more credit you get. But it's not even. It's like, round numbers. It'll be like $3,000 for the first child, $2,000 for the second child, and then $1,000 for the third child. So, if you have several children and your income is in that range, and what's really interesting about it actually is that there's actually a ramp up as well as a ramp down. So if you have three kids and you make $10,000 of earned income, then you're going to get less earned income credit than if you make $20,000. And then at $50,000, it'll be decreased and then down to zero. So there's like a stepwise triangle, or not triangle, a trapezoid kind of shape to the earned income credits. And I've never really seen a satisfactory explanation of why that is, because if you have three kids and you make 10 grand, don't you need just as much money as if you have three kids and you make 20 grand? I don't know. But that's the way the law is written. And obviously the numbers are adjusted every year for inflation and all these kinds of things. Yeah, fundamentally, if you have children and you don't make enough in the opinion of the federal government, they will give you extra money for it. And that's what the earned income credit is. So they want to support the, what we would loosely call the working poor who have children. And but yeah, it's just a standard credit that gets filed. Every tax software I've ever seen will calculate it, pretty easily. And there are certain situations where you don't qualify for it, but it's rare. I mean, if you're a U.S. citizen, your kids live with you, and nobody else can claim them, then you're entitled to it. There can be sticky situations with cases of divorce, and it's like, oh, who's claiming this kid and who's claiming that kid, and situations where it's not amicable, right? So like, one parent tries to claim the kid, illegitimately, and tries to, submit before the other parent can do their tax return. That could be a whole mess. But barring that, then and just for the record, the earned income credit, there's tiebreaker criteria built into the credit to determine who gets the credit for which children. And fundamentally, it's going to primarily go to the parent that the child lives at least 50% with. So that's typically the thing. See, this is a whole it depends thing, because there could be divorce decrees where the court says one thing, the IRS says another. That's a whole back and forth. The courts end up winning in that situation, by the way, but it can be a struggle. All right. With that said, we are out of time. I know we had a short one today, but we'll get everything, all the technology working properly next week. But that'll be the 19th at 6 p.m. Eastern. In the meantime, become an Explorer. Explorer is our free group, where you can get notifications. I didn't send one out today for this because I ran out of time, but you'll get notifications about workshops and new tools and all these kind of things. And there's a whole bunch of stuff in the Explorer learning portal already that has like tools and calculators and guides. I've been sending out like the partnership blueprint guide a lot lately, because people keep saying it's like, oh, I'm going to be doing this thing. It's like, let me send you this book I wrote first, because it's the 13 things that you need to discuss with your partner or partners before you actually start. Because all these situations are things I've seen go bad. And if you have these conversations on the front end and decide how to deal with it as a group before the bad thing happens, then you have a plan. If you wait until the bad thing happens, then you're stuck because it's too late. So that's one that's in there. It's a freebie. All you got to do is sign up for the Explorers, and just go to taxsherpa.com/explorer, and that'll take you there, or scan the QR code, and that'll take you to the same site. You just put in your email and you'll be granted access. All right. With that said, I appreciate everybody. And we will do this all again next week with the full time, because I'll make sure that all the tech is working beforehand. All right. Catch you guys later.
All righty.